Our next guest calls it a moment of dual fragility for equities, but believes the recent dip will likely be bought. And that's certainly playing out today, although off the morning lows. Fundstrat's head of research and CNBC contributor Tom Lee joins us. Tom, you've been good about taking things like, say, a job print or CPI and arguing that it's an opportunity if there is a dip. Is it a harder call when it does involve geopolitics?
It's definitely a harder call because the scope of the path this escalation can take place is unknown. But at the same time, we can look at sort of past episodes and past war instances or conflicts and understand how markets react and where positioning is. And I think that's what's giving us some confidence today, that there's a lot less leverage now. And I think the Fed's in a very different position where the Fed could be supportive. And that's why I think, as uncertain as it feels right now, I think this dip will be bought.
Does it create downside risk for your year-end target, let's say?
I think when you move beyond the 1 month, even 3 months, or even 6 month timeframes, I don't think that these actually affect the trajectory because, the drivers of our year-end target are this recovery in corporate profits, the upturn in business confidence measured by ISM, the fact that consumer leverage is still quite low, and that monetary policy is actually supportive of the business cycle. So I think these things all are still at play between now and year end. And, I think our 5,200 target is too low, but I think it's still too early for us to raise our target as well.
Yeah, I read your note over the weekend. I cited it. A lot of it does rest on this idea that the Fed is in a very different mode. And as you referenced, they're sort of in easing mode. But the story, Tom, has been that they are not going to be able to ease so easily or so quickly. And today's retail sales data only adds fuel to that fire. So I do wonder how much of your thesis depends on the Fed cutting this year.
Sarah, I think it's important for the Fed to be dovish this year. And in terms of how many cuts they do, I know there's going to be a lot of debate about, well, is it 3 cuts or is it 2 or 1? But it's really going to be the reasons why they make fewer cuts. If the economy is resilient and inflation is not accelerating, so they end up doing even as little as 0 cuts, that's actually quite bullish because, one, the Fed still has a lot of firepower to make future cuts. And it just shows you the economy is handling higher rates pretty well. I think it would speak really well for equities if the Fed made fewer cuts, but for the right reasons.
To the extent, sorry, your thesis depends on obviously earnings coming through. We're at the beginning of earnings season. What are you looking for both now and through the back half of next year in terms of S&P earnings and growth rate?
Well, earnings in the fourth quarter that was reported 3 months ago came in close to 8% above expectations. That's already flowed through into what we expect for 2025. First quarter's already looking pretty good. More than 80% are beating. So I think our 2025 earnings, which is officially 260, and that was 8% earnings growth, is probably low. It's looking like it's going to end up being closer to 270, maybe 275. That's a $15 higher earnings for next year just because of the strength of earnings we're seeing now. So I think profits are coming in pretty well. Inflation's cooling, but companies are still finding operating leverage.